You watch a stock absolutely defy gravity for an entire quarter, climbing 154%. Then they deliver a massive 50% jump in revenue, and the market just mercilessly dumps it in after-hours trading. Welcome to Earnings Unscripted. It's Tuesday, August 4th, 2026, and we're looking at the Q2 print for AMD.
Yeah, the price action's genuinely brutal today. The stock ground higher all day right up to the bell, and then literally every cent of those regular session gains vanished the second the release hit.
That's honestly wild to me because operationally, they really delivered on the core story. Revenue came in around $11.5 billion. Non-GAAP EPS landed at 166 a share. They're both up massively from the prior year. So what actually broke the momentum?
The baseline broke it. When you've got a multiple inflating that fast in just 3 months, a solid beat's basically a disappointment. You've got to walk on water to justify holding those highs.
Right. And since we're tossing out hot takes on volatile price swings, this whole chat's just our personal read on the data and not financial advice. But still, even with perfection priced in, they generated a ton of cash. Did the internals actually look worrying to you?
Well, top-line profit's definitely there, but free cash flow actually dropped pretty hard sequentially. CapEx basically doubled quarter over quarter. They're spending incredibly aggressively to scale up these new AI silicon systems. They've just accepted that they need to bleed cash on infrastructure to feed the ecosystem.
Which makes perfect sense when you look at how they're selling it. They actually started bundling a free year of Hugging Face Pro for anyone who buys their new Ryzen AI developer systems. It's essentially an adult Happy Meal for software engineers.
Buy the hardware, get the premium model access free. It's a very smart way to lock in developer loyalty, but it's not a cheap strategy. And they need that new enterprise momentum desperately because the legacy stuff's dragging. Gaming revenue fell off significantly year over year as the current console cycle matures. The data center segment's completely driving the bus now.
Completely, which brings up this one tiny, bizarre line item I caught in the filings. I need you to explain why AMD is suddenly paying a 25% U.S. import tariff to export their own chips to China.
Because government red tape's undefeated. So the government actually granted them export licenses back in February for these new MI series accelerators, but there's a catch.
There's always a catch.
Exactly. The mandate says these specific parts have to undergo physical domestic inspection first. Since they're manufactured in Asia, bringing them onto U.S. soil just for the government to look at them technically exposes AMD to that heavy import penalty you mentioned.
Wait, let me make sure I'm hearing this right. China's taxing them because the U.S. inspected the chip?
No, that's the absurd part. The U.S. government's taxing them. They're paying an American import tariff on their own hardware just so an American inspector can look at it before they export it again.
You can't make that up. So they're essentially paying a massive toll just to get their own government stamp of approval?
Right.
Who's even absorbing that margin hit?
Right now, we don't really know. That's the billion-dollar question. But honestly, I think management views it as a necessary evil because they're playing a much bigger structural game right now. If you look at the filings, they just completely redefined vendor lock-in.
Okay, how so?
They issued stock warrants to OpenAI and Meta. We're talking up to 160 million shares, priced at a single penny each.
A penny?
A penny. But they only vest if those partners hit very specific Instinct GPU purchase targets and stock performance milestones over time.
That's fascinating. So instead of just offering a traditional, boring volume discount, they're basically turning their two biggest potential customers into highly incentivized shareholders?
Exactly. It's a massive equity loyalty moat. If Meta buys enough hardware, AMD stock goes up, and Meta's penny warrants are suddenly worth billions. It legally structures loyalty right into the supply chain.
It forces everyone's incentives to align perfectly, and that actually explains why Lisa Su sounds so incredibly confident about this ramp. Listen to her exact quote from the call. As AI moves into production across a broader range of applications and workloads, demand for both accelerators and CPUs is growing well above our prior expectations.
It's an understatement. They completely shocked analysts by raising their total addressable market projection. 6 months ago, they thought this was a $400 billion space. Now, they're estimating the data center accelerator market's going to hit $1.4 trillion by the end of the decade.
It feels like they're just ripping up the old models and assuming demand's basically infinite. But what happens when you start scaling that fast? Doesn't the whole hardware production pipeline start breaking down?
Well, it definitely creates friction, and they're acknowledging that. They specifically warned about a softer consumer PC market hitting them later this year. Skyrocketing component and memory costs are already squeezing the broader consumer goods sector. The AI side's literally sucking the oxygen out of the room for normal computers.
So if you're building everyday laptops, you're getting priced out of the supply chain because all the components are being hoarded for these massive server racks.
You got it. And this isn't just about throwing metal at the problem. They're actually using AI to fix their own software deficit now.
Oh, right. Their ROCm platform, the one everyone used to complain about?
Exactly. For years, developers hated it because it couldn't compete with the leading software ecosystems out there. So last month, AMD introduced this utility called ROCm.ai. Instead of hiring thousands of engineers to rewrite competitors' code to work on AMD chips, they're deploying large language models like Anthropic's Claude to autonomously port and optimize the code for them.
Okay, wait. So they're having artificial intelligence train itself on how to run better on their own artificial intelligence hardware?
Yep. The hardware ecosystem's literally improving itself. It raised software efficiency more than twofold without human intervention.
That's incredibly meta, but also brilliant if it works. It saves a fortune on R&D.
It does, but they still have to physically build the ultimate systems. Which brings us to Helios, their new rack-scale platform. Ramping that up's going to be painful.
Why painful? Just the sheer scale of it?
Scale and complexity. When you pack that much advanced silicon into one aggregated system, your manufacturing yields are naturally awful at the start. You're throwing away a lot of expensive parts to get a fully working rack.
Which drags down corporate gross margins until they perfect the assembly line.
Right. So we've got exploding data center demand, incredibly expensive new architectures, and an equity structure tied completely to execution. The pressure to build this right the first time's unprecedented.
Does an operation that massive even leave room for error anymore?
Barely. And that's exactly why the market dumped the stock today. When you're completely rebuilding your architecture around these massive new server racks, a single manufacturing hiccup basically blows the whole profit profile.
Right. When you're priced for absolute perfection, any tiny inefficiency gets punished. But management doesn't seem rattled at all. I mean, their outlook for Q3 is still massively aggressive.
Very. They're guiding third quarter revenue to roughly $13 billion. That's a huge sequential leap, and it's entirely leaning on data center growth to cover that falling gaming demand we talked about.
And how does that crazy infrastructure spending actually hit their margins going forward? I mean, with the Helios systems ramping up and all that heavy R&D happening.
Well, they're modeling for gross margin to hold steady around 56%, but operating expenses will jump to about $3.65 billion just to keep feeding the development engine. So they're totally relying on server revenues catching fire in the back half of the year to cover the bill.
Which means they can't afford to be wrong. If you're promising $1 trillion future market, eventually, investors want to see the profit, not just the massive building costs.
Exactly. And you can see them hustling to find cash everywhere, like that ZT Systems buyout. They instantly divested the manufacturing wing to a third party and actually structured an earnout provision where they'll get up to $450 million in extra cash if performance milestones hit over the next few years. They're squeezing capital out of every single corner.
So if you're buying into this story, you're signing up for a wildly expensive balancing act. They've got those equity warrants locking in huge enterprise clients, but they're fighting soaring internal costs at the exact same time.
It's a fragile ecosystem right now, but if they actually pull this infrastructure off while boxing out the legacy competition, the payoff's generational.
I think that's a great place to land today. They're swinging for the fences, and we'll just have to see if they clear the wall when the next print hits. Thanks for hanging out with us, everyone.
See you next time.
If you're enjoying the chat, make sure to hit follow so the next breakdown drops straight into your feed. And as a quick heads up, we went from AMD's live earnings call directly to your speakers today because this whole show, our voices included, is a completely synthetic AI production, testing if finance can actually be entertaining. We'd love to know what you think or what ticker we should cover next. So email us at earningsunscripted@datamadness.ca or tap the X link in the show notes.
See you next quarter.